Hey guys, you're listening to the Tascha Labs podcast, and today we are going to talk about angel investing in Web3. I know this is a topic and a lot of people are interested in, especially given the time we're in right now, right? We're in a bear market and the liquid token market is not doing that well, and the venture market is down as well. So, this may be a time to think about, okay, you don't want to get into venture investing at the top of the bull market, right? Because everything is so expensive. But obviously, that's the same thing is true for the liquid token market as well. But at this time, I think it may be an interesting time to start thinking about early stage investing if that's the kind of thing that you're interested in, even though I think the early stage crypto investing is kind of an oxymoron because there's no late
Right.
stage for crypto. Everything is early stage, right? But anyway, I digress. So, to help our discussion today, I invited my friend Paul Pesek, who is the co-founder of WAGMI Ventures. That is a Web3 focused angel investor syndicate that has been growing very fast, to join our discussion. So I'm really excited about today because I'm really looking forward to hearing Paul has to say about, Web3 landscape, the investment process of angel and venture capital investing in Web3, and how you should think about portfolio allocation if you are considering going into this kind of early stage in Web3 investing. Okay, so let's get started. Hey, Paul, how are you doing?
Hey, Tasha. Good. How are you?
Good, good. Thanks for joining me today. So let's get started right away. Give us a little bit of background of you personally and how WAGMI got started.
Yeah, sure. Happy to. And thanks again for having me on the podcast. So I have a TradFi background originally, as do many people coming into the space. So um, my first 3 years out of undergrad, I spent at McKinsey doing management consulting. And then I spent 3 years before business school working for a private equity fund. Then went on to Wharton, and it was really at Wharton that I started to get more excited and involved in Web3. So, I can kind of go into that side of the story. Um, my co-founder for WAGMI and kind of close advisor right now, Graham, he is, somebody who has been very deep down this rabbit hole within crypto for a long time. And he's part of Figment. They've done a number of interesting things with staking and validation across chains. And, he gave me and my wife 1 ETH back when it was $100 as a wedding gift. And we've kind of watched that roller coaster go up and down over the past several years. And then on my side, funny enough, while I was at Wharton, it wasn't even a Wharton colleague or, somebody in my class, but I had made good friends with the doorman in my building. And, every morning I would go downstairs and Mike was always, trading on his phone or doing something, really, really sharp guy. And, we struck up a friendship and, he would tell me about how his daughter's making digital art. And, she was doing this on an iPad that they had gotten her. And then, fast forward a few months and she had made some art that was being sold in the metaverse for ETH, in some museum that was being put up. And it's like, wow, Mike, that's really impressive. I've traded ETH on Coinbase and even sent some to a non-custodial wallet, but buying art, that's great. And so then, fast forward another month, and he said, Paul, my daughter is making this thing called a generative art collection, which this is early 2021, and she's 12 years old, and she had basically put together this collection of long necky ladies is what it's called. So Nyla Hayes is the artist. If you know her, you know where the story's going. But Mike said, hey, I'll send you one. And so I said, great. Do I need to give you a MetaMask? And ultimately I sent him my address, and he sent me one of his daughter's pieces of art. And sure enough, a few days later, celebrities like MC Hammer and others start tweeting about it, and they're incredibly excited about what she's doing. And fast forward several weeks, and they've made millions off of this collection that she's done. And so, Mike promptly quits his job as doorman of our building, but we stay in touch. We're constantly then exchanging ideas for other NFTs to trade, and that kind of, helped me catch the bug. I think in late 21, I joined Proof Collective, which was, really interesting cohort led by Kevin Rose of builders and just hardcore NFT collectors. So after catching the bug, kind of found that like-minded community through his group, and they did some really interesting stuff in early 2022, and then launched Moonbirds, which has kind of gone on to become its own thing. But it was really getting to be a part of that token-gated community and getting to meet a bunch of other interesting people in the space who were also investing in other things that really got me excited about all the just building that was going on within Web3 at the venture stage. And so chatting with Graham, who had been my roommate in college, we had just observed this phenomenon where all of this capital had rushed into the space in 2021 and even early 2022, where you saw a bunch of traditional venture funds raising record levels from their LPs, their limited partners. And it basically devolved into all of these funds competing for the same high quality deals and trying to justify
Or sometimes
why.
not so high quality deals. I'm sorry.
Unfortunately, yes, and that's kind of the story of 2022, right? So
yeah, anytime you have like such huge surge and rush in of capital, there's definitely going to be massive misallocation. That's just unfortunately always true.
that's right. Yeah, and I think we can get to. I think why 2023 is a very healthy year to be looking at this space. But in 2022, what you saw was everyone fighting over the same deals. Really, the ratio of capital to exciting projects kind of basically became unsustainable. It reached a too high of a level, and you saw that lead to higher valuations. And so, taking a step back, we did still see a lot of exciting innovation get built. I mean, that's why so many of us are sticking around during the bear market. And we just thought, man, it would be really exciting to try and find a differentiated way to get into these projects where, I don't have the kind of resources that Sequoia or some of these larger funds do, but I do have pretty good network now of other builders within Web3. And I know Graham does, and I know other friends in the space would be interested in participating in these kinds of opportunities. And so our whole value proposition at WAGMI evolved into this strategic network of partners that at first grew organically, and now it's really snowballed, frankly, beyond anything I would have expected last year, and kind of just casually getting into this and seeing a real value proposition that could be offered to founders. We pitch this as, we're one line on your cap table, but underneath that, you get a collection of maybe 20 to 30 angel investors who, in addition to writing a 10K check or whatever it might be, they're then really incentivized to go out, hustle, make introductions to distribution partners or people that might be good candidates if you're hiring for a specific role. As you know, I'm sure through just your network, there's a lot of serendipitous connections that can be made. And so the law of large numbers in our network is kind of leading to just a lot of exciting things, both on the support side for companies and also on the deal sourcing side, which I know we can talk to. But essentially, this snowballed way faster than I would have expected. The goal was originally to do a deal a month. And at this point, you see our memos, we're going with around a deal a week. So don't know how sustainable that will be in the long run, but there's so much exciting stuff being built right now at valuations that we personally feel much better about. So we're just trying to keep up in 2023 and bring as many exciting deals to our network as possible this year. So
can you give us some summary stats in terms of what's the investor base growth rate right now? And what's the frequency of deal? You already said about once a week right now, but how many people are investing each of the deals? What's the check size?
Yeah, sure. So I think I'll start by saying that the way that we think about it is probably on a deal by deal basis, just given we are spinning up individual SPVs as opposed to having actively managed capital. So on a deal by deal basis, we average about a 200K check size.
Mm-hmm.
Now that's granted a little skewed because we tend to do smaller deals, but then every now and then there's a really exciting larger deal that we'll get into. So we've done a few as large as $1 million. We're actually syndicating one right now that really excited about, that we will hit the $1 million mark on. But typically, if you want a median, that's about 150. And then on the lower bound, for people who are less familiar, the way that syndicated deals work is you spin up an SPV, and we can talk about how
That's a special purpose vehicle for people wondering.
Yeah, special purpose vehicle, and that's really, I think, revolutionized angel investing, or at least all of the infrastructure that's gotten built out around that more specifically. But what that does is it lets you pool capital through a single entity in a compliant, regulatory compliant way, and then send that on to the company as a single line on the cap table. So, whenever you spin that up, there's a fixed cost to doing so. And so if your check size is too low, it starts to eat into the fees, start to eat into the investment that your check writers are putting into the deal. And so we cap our deals at 100K as a minimum, just to ensure that we're not having too much dilution up front. So really about 150 is the median, closer to 200 is the average, and we've done 25 deals at this point. So I guess, with this next one, we'll probably be closer to 6 million deployed, but in general, we're trying to pace at about a deal a week. So that can kind of give you a sense for, and then in terms of size, so you asked about the size of the underlying checks. We probably have, even just in real time, this current deal that we're doing, where we're raising $1 million, our average check size is just above 10K, but our median is right at 5. There's so many 5K check writers, which is really our minimum, because administratively it's tough to handle a larger number of checks for just a potentially infinite number of people. But what that does is it really lets a number of people get into these projects that otherwise wouldn't be able to if they were trying to knock on the door of somebody raising a $16 million round at a several $100 million valuation. And so really, in some ways, we're creating access to smaller check writers to some of these really exciting deals that exciting funds are investing in that normally you wouldn't have access to if you were just trying to invest on your own. So
totally. So I totally see what you're saying about the value prop. On the investor side, it's basically crowdfunding for the angel for angel investors, right? As an individual investor, you're probably harder to get into those deals, but as a aggregate check size that's a little bit bigger for companies, it's less of a hassle to handle. On the other side, for companies, this is kind of an early stage PR for them because they get a bunch of smaller investors, but maybe highly influential investors also in the space, right? So I think both parties get something out of it for sure.
Absolutely.
So can you talk to us about how you think about this investment process when you obviously, I want to mention the other benefit for individual investor I see as this kind of model is you guys are kind of doing the first pass evaluations analysis for projects. So you need to pick a bunch of projects, right? So can you tell us in terms of how that works on your side, in terms of how where do your deals come from and how you think about picking those deals?
Yeah, absolutely. This is probably, I should have done this at the beginning, but this is probably the time where I cue the statement that none of this is financial advice. And
well, totally. Needless to say, none of us are giving financial advice here. We're just chatting, right? So, okay, but this I think
of
is
course.
useful information.
Of course, yeah. And, I think even at the WAGMI level, we aren't managing capital ourselves. What we're trying to do is bring high fidelity deals to a collection of people who are interested in investing and participating. And to your point, we therefore have to do the initial screening of these opportunities. And I would say that for every deal that we do, we probably get pinged with 20 other ones. So maybe you could call it like a 5%, investment funnel, just in terms of looking at deals to actually doing them. I think maybe it's helpful to start with where the deals come from. So one of the exciting things about having this network is that as people start participating in deals, or just seeing that there are opportunities out there, they get excited when somebody they know is raising for the project that they're building, and so they'll bring that to us. And so I get a ton of inbounds from people in the syndicate who say, hey, I know so and so is raising. Have you guys looked at this opportunity? And so we get a ton of great deal flow that way. I mean, I love hearing from our members, and for them, it's also an opportunity for them to jump on board, because maybe they're not able to write the kind of check size that a prolific angel investor in Web3 like Balaji, or some of these others who are cutting much larger checks would be writing. And so that's really the main source, is through our own network, just of people within the syndicate. We also have kind of friends at all different kinds of exciting dApps, or different layer one ecosystems. I know a bunch of people at other venture funds, and so typically speaking, or generally speaking, we tend to get I would say pretty high quality deal flow up front, and then how we kind of categorize or filter is probably the next part of this conversation, which would be really when you're looking at these things. I mean, it's in some ways analogous to when you're writing a resume, or thinking about trying to put yourself in front of a job opportunity. Often employers are looking at so many resumes in the stack that they kind of inherently have to develop an algorithm to just screen. And we really wish that we could give every project the same amount of time, but at the end of the day, what you're looking for are a few very specific things. And so I think in our case, the first one by far and away is the team. So just trying to understand the strength of the team. Have they built a business before? I mean, ideally something within Web3 that already kind of demonstrates their track record. Have they successfully exited something before? Do they have the right team around them? So if it's the founders, have they attracted the right talent to help them build whatever they're developing? And I think in so many instances, you're going to have a startup that wants to do one thing on day one, and then realizes on day 180 that somebody else has actually done that, and they need to slightly pivot. And so I think
that it probably happened to, like, I would say more than 60% or 70% of startups.
Yeah, exactly. And so in some ways, at the earliest of stages, you're really backing the team and the people who are building. And if you think that somebody's high enough caliber to be able to pivot reliably until they're going to be successful inevitably, then that's kind of the first, by far and away, biggest screen that we would use. The second one is with respect to the product or service or protocol. Is it something that is exciting, that has an attractive go-to-market case for existence? So something that I think it was probably less vetted over the past couple of years was just the utility of some of these things. I think especially during a bull market, it's easy to really just jump on board any kind of project that has an exciting set of names behind it, or you know, a strong pedigree in terms of the team that's building. But if there's some clear use case for whatever the product is, if it's something that you can actually understand, break down, be able to, you know, describe, if you're just excited because something has the word zero knowledge proof in it, then you might need to actually slow down and understand what the business is actually doing, right? Because otherwise you'll get swept up in certain narratives that are, you know, maybe pervasive in the industry in any given moment. And it's easy to be driven by FOMO if you're not actually comprehending what the underlying technology or company is doing, and if it, you know, has a viable, clear use case. So I think that's especially also useful for angel investing and kind of a smaller retail audience, is, you know, if they can really understand, maybe even have used the kinds of products or, you know, services or protocols that we're bringing to market, then that can be really compelling as, you know, kind of a just driver of growth for the company. So
Do you think it's useful to have a top-down thesis of some sort? For example, certain sectors that you expect to grow more, so you kind of focus more in that segment of projects, that kind of thing?
it's a great question. I would argue that if you are a traditional venture fund, then that makes complete sense. I think what you see with a syndicate, especially as you reach an increasingly large size, is that it's kind of law of large numbers. You know, statistically speaking, you're going to have people who are interested in late stage deals, early stage deals, real world assets, gaming protocols, right? And so I think what we're trying to do is cultivate and keep this network engaged that is essentially getting their itch scratched on, you know, various different sub verticals within Web3, where we're trying to remain industry agnostic and just bring the best deals across the space. Do I personally have certain areas that I'm more interested in than others? Yes. But in general, if we're trying to service this growing cohort of people who are coming from all different verticals within Web3, which is kind of our syndicated model, then I actually think it's less important that, you know, you have some sort of thesis, because everyone within the syndicate will have their own
Right.
areas of interest.
Yeah. So yeah, you're totally right. Right. So from the syndicate level, you just like bring up projects that you know, that fits that kind of criteria that you just mentioned, but it essentially still boils down to each individual's choice and their own. They have to do some of their own due diligence on their own, right? The members. But just like in terms of you personally, is there any sector that you're particularly interested in right now?
Yeah, sure. I won't pick favorites from within our you know, our cohort of investments, but I think
Just don't talk,
one of
like, how about outside of your cohort investments? We're not like recommending investment projects here, so.
yeah, absolutely. So I think that there's some really exciting stuff that's being done with real world assets right now. Specifically, it's kind of interesting. So a lot of the past couple of years was fueled by cheap interest rates, kind of a zero interest rate phenomenon. It's maybe something that you've heard. And so I think now that we're entering this phase where, you know, there's a Fed funds rate of, you know, something close to 5%, you really have to justify utility for your existence. And I think there are some really exciting things being done in the real world asset space that allows for tokenization of assets that maybe wasn't possible. I mean, everyone loves to talk about tokenizing real estate. You know, I'm not particularly super informed in that specific subvertical, but there are so many other real world assets that you can tokenize. So, you know, for example, one company that, disclaimer, we are WAGMI Ventures has invested in, N Labs, is tokenizing receivables. And so, you know, there's this arbitrage opportunity, or maybe capital inefficiency is a better way to describe it, where you have gig workers throughout the economy who are 1099 workers essentially who are maybe doing last mile delivery for Coca-Cola, or on the consumer side it'd be somebody doing Uber or DoorDash, who are getting paid maybe bi-weekly, or some of the corporate cases monthly for the work that they're doing, or maybe on a PO by PO basis. And in order for them to receive the cash for that, they would have to wait for the receivable to come due. And if they tried to borrow against it, as an individual, you're far less creditworthy than a large organization like Coca-Cola. But if you can actually tokenize and through zero knowledge proofs show that this is a creditworthy borrower, but it's completely anonymized, which is what Labs is doing, then you can essentially show the creditworthiness of the receivable and let somebody access a much more capital efficient rate to borrow off of that receivable to get paid immediately, as opposed to 30 days down the road or 60 days down
Right.
the road. And so pool, by tokenizing things and using some cryptography in order to make a more efficient lending market. So things like that, that's just one example of something that really I think is exciting, that is starting to get built out. You've got a lot of other interesting things that are being done on the not broader, I mean, there is fascinating stuff being built in the broader zero knowledge space, but frankly, a lot of that starts to get into complex math and cryptography that's a bit above my head, and that will bring in more technical advisors to support us with diligencing. But I think just some of the fundamental basic tech that's being built out to leverage zero knowledge proofs in specific instances like what I mentioned, or to give minimum viable information. I think in Web 2, one of the problems has just been all of the capturing of individual data that in some instances people haven't been aware of, but using that and packaging it to treat the user as the product, in a sense, with zero knowledge proofs, you can selectively show through off-chain verifiable credentials the specific things that are important to you in a given instance. So I think there's a lot that's going to be built out in that space, and I'm hopeful that in the bear market there's a little bit more calm for people to just soberly select the things with very clear use cases, like what Labs is doing, as opposed to just rushing ahead with a narrative that maybe naturally excites people, but doesn't.
It's like at the beginning of any new technology, like people will want to apply this, when you have a hammer, you see everything as a nail, right? So
exactly,
you will want to apply this to everything and anything, and eventually something useful will come out of it, but that's probably, 1 in 10 or 1 in 100 scenario, right? So, but anyway, but my next question is, is there any difference that you see that is very unique to the Web3 angel investing or venture investing, as opposed to just a general early stage startup investing?
Yeah, sure. So I would kind of break that into two parts. The first would be just the sector or set of sectors itself. I think the fact that we're investing in a space that doesn't have any regulatory clarity yet, that is constantly being, I guess, disrupted by itself. You've seen these different phases where the people who were early to Bitcoin weren't necessarily the people who were early to Ethereum in all cases, and then people missed, the rise of other layer ones, and I think a lot of the ongoing innovation. It just shows how early this space is, and so I think that makes it, in some ways, particularly challenging to keep up with crypto in its totality. But at the same time, it just shows how much opportunity there is for more building that's going to continue in this space. So I think we're still in the first or second inning of an incredibly nascent field, and I think you have to keep that in mind with respect to investing in crypto specifically. And I think it's why a lot of us who try out, like a non-custodial wallet for the first time, and you send your money across the internet, and all of a sudden, you feel that sense of self-sovereignty, for at least for many people. I think that it's kind of a one-way direction. A lot of people experience that, and then it's hard to go back. And I think it leads to a conviction that this is an incredibly exciting space that we are still early in. So generally speaking, that's my sense with respect to crypto as an industry right now, is that there's so much stuff getting built.
But how is that different from any other like early stage sectors that people generally invest in, like other venture capital segments? So here, let me give you one specific example. I think just the fact that we're not able to pin down what's a security within crypto and what isn't. I mean, tech by its definition, to your point, is kind of the tip of the spear, right? But then with respect to governance, ownership, and a lot of these fundamental things that for so long were taken for granted in very simplified structures, have now been kind of pushed aside as old or dated. I mean, the fact that the Howey test is based off of an Orange Grove case from the 1930s is just emblematic of the fact that we're dealing with something radically different here in the way that we define ownership, the way that we define governance. And so I think the fact that crypto it's like a liberal arts person's playground, and that it touches so many different domains, and it's a way that society's kind of that has the potential to be restructured. I think it makes it a little bit more expansive than certain other fields, and kind of goes back to the point that it's harder to keep track as a result of everything that's happening within crypto. Okay, but how about operationally? So as a, like an angel investor or a venture investor, obviously if you invest in other sectors, you only have only have so many options in terms of exit, right?
So the through line.
Yes,
exactly. So the through line here is that within Web3, there are actually a number of different avenues to exit, and some of them are new and not available in traditional industries. So one thing that if you've done angel investing in crypto, you might be familiar with, the listener, not you, because I know you invest in a bunch of companies, but if you invest in equity, you might also be given token warrants. And so what happens is, traditional company, when it exits, it's either an IPO or a sale. In a number of these crypto instances, what these companies are building is a protocol that's going to get launched that ends up issuing tokens. And if you're part of the early investor cohort, you may actually get tokens in addition to the equity. And depending on the company, the equity could be worth something, or it could really just evolve into the token for the protocol being worth something. But the fact that you have these kind of two paths to a liquidity event, with the traditional equity of the company you're investing in being one, but then also if they issue any kind of token and you're given a right to that as a investor, then that's an entirely new domain or avenue for people to get paid.
Sure. So I think actually for for VCs, I know like some traditional VCs are trying to get crypto because one of the things obviously it's a growing sector and blah, blah, blah. But one of the things that people also see is like you have this additional, like potentially much faster exit, which people complain about, I know, but if you're a retail investor, but if you're a venture capital or if you're like an angel investor, this is something that you got to think about, right? So because investing in crypto, you have much earlier exit compared to traditional VCs. I don't know, like, are you familiar? Like, what's the traditional like exit timeline for like average, like, I don't know, in software?
I mean, that could be in the 5 to 10 year time frame. There's a really high variance with. So it's interesting. At the beginning, you mentioned the market's down. I mean, if you want to place bets within crypto, but not have the ability to undo those bets whenever you're feeling doubts in the space. I mean, angel investing is a very illiquid investment. You have high conviction, you put something in, and then you're stuck with it for however long.
Well, it cuts both ways, right? So you have on one hand, this kind of traditionally this kind of early stage investing, because it's illiquid, you really have to like measure twice, cut once, right? You really have to really think through, because your exit timeline is long. With crypto now, you can. It's like on one hand, the room for error is bigger, because if you don't like if it doesn't turn out as well as you expected, you can sell with liquid token in many cases. But you could also, the more decision you make, the more errors you can make. There's also that aspect as well.
Very true. Interestingly, I will just say that with a number of these projects too, in order to avoid that happening with the cap table and people kind of exiting in mass, oftentimes what you see is a lockup or a vesting schedule for tokens. So if there's a token generation event and you're an early investor, you might get some of them up front. There might be what's called a 1-year cliff is sometimes common. So, you have to wait, and then a year later, that's when it starts to vest, and you get, upfront that uptick. That's the cliff part. And then sometimes you'll see like linear vesting, for example, over a several year period. So you can dump it, but it's in.
You can dump it in small segments. But like, what's the average like vesting period that you've seen like common so far? Is it like 2 years, 3 years?
Yeah, 1-year cliff with 3-year linear vesting. That's the most common that I've seen. I mean, I would say that's fairly common, and that just kind of aligns incentives. Because the thing about a token, if you're coming at this from a builder's perspective, is once you it's the same with equity, but once you let that cat out of the bag, then there's no going back. So you don't want your token to tank. And I think a lot of people are now kind of intelligently designing these so that they unlock over periods of time.
So in terms of like token allocations, like what percentage of the projects that you invested in so far? I know its sample size is probably pretty small still, but like what percentage of them have like some kind of token warrant attached, or the deal is directly in token format?
Yeah, Tascha, we'll hopefully have a statistically significant sample size.
I'm sorry,
I'm
an economist, so I'm just like, interesting numbers.
Yeah, I love it. So it's funny because it might actually be deceptive to describe it that way, because I have conversations with founders every day where they're looking at deals or they're going to market with their companies, and we're looking at their deal, and they're like a SaaS business, but because their investors want protection, they're also adding a token warrant in case they issue a token in the future. They're like, we don't think there's going to be a token here, but we get it. We get that the VC wants to be protected, so we're including a warrant if we ever do it. So I would say probably around 50% of the companies, maybe more than that, have a token, and then call it 10 to 20% are pure token deals. So we've done some of those, and then the remainder are just pure equity, and that's a number of cases. But the vast majority do have some sort of token warrants. Now, whether those actually ever come to market as real tokens is an entirely different question. So.
Yeah, and also I think for people who are investing in this, like these Web3, deals, it's interesting to think about, what value is backing the token, and what value is backing the equity, right? So the way I think about it, like for equity, is pretty straightforward, because that's long-standing financial instrument. You basically has a claim on the bottom line of the company as shareholder. So, but the vast majority of the Web3 projects really have no idea of what their token is used for. But everybody is like nowadays have to issue a token of some sort because people are asking for that token. But the thing is, I think the best case scenario, well, not the best case scenario, but like one one kind of like scenario that makes sense to me is like it's backed by the value of part of the company's goods and services. What I mean is, for example, if you look at airlines, airlines have airline miles that they give or they sell to their customers as like loyalty point or as a cash flow generating method for airlines. But airlines also have shareholders, right? So if you look at the numbers, the value of airline miles is actually way above the value of the airline industry's equity. And the reason is because the equity is, again, the bottom line, and the profit level of airline industry is whatever it is, right? So, and it's not very high. So, but
Right.
the token, not token, but miles, but basically the Web2 form of tokens is backed by the goods and services that the airline industry has to deliver. So that market cap of those miles is essentially backed by the market cap of the sales of the industry, not the profit of the industry. So
Right.
that's one way I think about that's the conditional on that's the use case for the token. But for most of the projects, who knows?
Yeah, I know that's a really interesting example too, and it's funny because the airlines have their own money printer that they can turn on and inflate the miles value whenever they want. And in some, in that example, it's interesting because the miles are kind of trapped within your own account, and the only way to monetize them is to essentially burn them back to the airline in order to get credit for them. But yeah, I mean, I think it would be really interesting if things like that were tokenized and made more fungible across an exchange or something like that.
So when you do these like project valuations, do you consider? I know you talked about your top criteria, the team, the product quality, and so on. Do you consider the valuation level and also the investment terms?
Yeah, absolutely. So we kind of segued in the middle, but the next piece is the valuation, and I think we're seeing a lot more exciting. From an investor standpoint, a lot more exciting valuations in 23 than we were in 2022. But that's a huge part of it because, that stands to benchmark what price you're getting in at, and as a result, what kind of upside you can hope to gain from these opportunities. So I'd imagine your follow-up question is probably, how do you think about the appropriate levels for the various stages of deals?
You read my mind.
Right. So I think just to give you some stats for us, I would say for our smaller deals, like seed stage deals, we're starting to see a number of deals in kind of the 20 to 30 million post money valuation. I think some of the pre-seed that's a little bit closer to concept, or just trying to validate proof of concept, don't have working prototype, but have maybe like a strong team that's has a strong kind of case for what they're doing, raising closer to that 6 to 10 million post money range. And then once you've developed traction and have proved that out, then we've seen a lot that are raising kind of a Series A level valuation, kind of around 100. And then, by all means, you can certainly raise and justify a higher valuation. We've had a ton of excitement on something that has gone at, several hundred million because of the total addressable market. So, you think about things in terms of, comps. A lot of times with valuations, you try to look at comparables, and venture investors are benchmarking. Okay, I've seen a bunch of deals raise at XYZ value, but when you're thinking about the upside for some of these larger L1 launches, for example, or maybe an L2, Well, one of the great ways to kind of think about what your opportunity is for return there would be to go and look at what some of the other L1s or L2s are trading at that you think are appropriate comp. And then, of course, that gets probability weighted, and it looks not as exciting if you're doing the probability weighting correctly. But just in terms of the upside, some of these layer ones can justify these multi-hundred million valuations because of the total addressable market that they could stand to capture at the end of the day.
Yeah, so I think I totally agree with what you're saying. You need to think about like how much is the upside that is left, and that is a sort of a comp calculation and also the probability calculation, right? Because if you are, well, we can talk about more of it, like how you allocate a portfolio and you think about the math, what's the correct expectation. But really, if a company is raising at like $100 million, you like, and if you're in crypto, you're like used to hearing the kind of 10x, 100x, 10x, like people nowadays thinking that is still like a small cake. But you think about like a 400 million company to increase to 1 billion, that's a big deal. And how many 1 billion above company are out there in the world, and even in crypto, right? So if you think about, actually, let me check. We can go look on like CoinGecko.
Yeah, I was just thinking that it starts to get pretty thin. It starts to get pretty thin.
I mean, that market cap ranking is dropping down to like 1 billion is like ranked about number 50. Okay. In terms of market cap in this environment. So you're talking about if a 100x company wants to go up 10x, it needs to enter the top 50 in terms of market cap.
Yes.
In crypto, right? So, and we know like there are how many tokens out there? About 1,000 at least with some sort of liquidity. Oh, the total token universe is about 10,000, right? But 1,000, I'm talking about those that have tradable liquidity.
Right, yeah. The liquidity piece is important there.
So I think that puts things in perspective a little bit, right? But we can talk about that in a minute.
Yeah, I don't know if you recall the stat, but I think the market surpassed 3 trillion at the height of
at the end of 2021. Yes,
exactly. And so trillion is just kind of a funny word, but it's 1,000 or 1,000 billion. So at some point, if the liquidity in the macro environment starts to come back around and you start to see some of the innovation that's taken place between 21 and 2023 start to get priced into a cheaper capital environment, assuming we do come back from that, then I think there's a lot of room for various projects to run. But right now, yes, the gravity of 5% interest rate is weighing down on people or projects more heavily than it was in 2021 and earlier.
I mean, for people interested, you can go back to check like what's the valuation, what's the cutoff for like top 100 tokens valuation at the heat of the bull market. Obviously higher than what it is right now, because like right now the total market cap is like about 1 trillion, and back then we are 3 times higher, right? So, but I think this is something that people need to consider is like what is the probability of that in terms of what's the upside that you can gain on each of these transactions, and also what's the probability that you will gain anything at all, right? So that's the other.
Yeah, so 2 thoughts there. I mean, first, the TradFi person in me would say that, Cambridge Associates and a bunch of these other fund-to-fund advisors have a bunch of great stats out there in terms of what venture capital as an asset class has done historically. And, depending on what vintage year you pick and when you're starting, it can vary, but typically above 20%, kind of closer to 30% is what venture capital is targeting on an annual basis, which might sound boring in crypto world, but there's I don't know if you're familiar with this, Tascha, but the kind of law of 70 with compounding, where if you just multiply the number of years by the rate of increase, and it hits 70, that's how frequently something would double. So with a 14% increase, it takes about 5 years for something to double. And so if you're thinking about that from your own personal investment standpoint, then 30%, that's kind of, call it 2.5 years, a little bit less, in order to double your money. If you can consistently do that every period,
Every
and
couple
continue,
years. You can push the bottom of every bear market and sell it at the top. That's
well,
if you can do that
humans really struggle to think, to comprehend compounding and the power. I think Einstein said something about compounding being like the most underestimated force in the universe, and I think that's very true, just in terms of the fact that if you do that 4 times in a row, so you do that for basically 10 years, then all of a sudden you've 16x'd what you've invested to start, right? And so, and then if you extrapolate that further.
So yeah, I think that's something that we should talk about, because that's also related to the investment process, which is element of the process, which is you need to have some level of consistency, right? So
yes, yeah. So that's part 2, which is we're talking about venture capital as an asset class as a whole, and I think people need to understand too that the phenomenon within venture capital portfolios, and there's actually a book called The Power Rule. It's been written on this. It's analyzed venture capital and performance over time. Basically, 1 or 2 deals return 80% of the value of an investment portfolio, and then the vast majority, unfortunately, are going to zero. And then you have some kind of mixture within that of other companies that are kind of base hits, or not that exciting returns, but you make each of those small bets in order to get the one that goes astronomical in terms of outperformance. And so again, like if I'm saying anything here, it's that we tend to think about this at more of a macro level, and I think it's very easy to have FOMO when you're thinking about various opportunities, but really trying to consistently put money into a diversified set of opportunities, and not bet the moon or bet the farm on one specific opportunity, is the way that you reduce your variance over time, and hopefully, assuming that you're tagging along to a deal that's been well screened by solid VCs, which is also something that's a helpful indicator to us, will increase the likelihood of you kind of tracking towards those venture capital level returns that are usually only available to the extremely wealthiest people within or the largest funds who are participating in a GP that's in venture capital. So I would say just don't FOMO everything into one project. It's really about trying to consistently make these small bets that kind of total up to a blended return that kind of reflects venture capital performance.
So just to give people a sense of put some numbers to the discussion, which I agree for the most part of everything you said is like, you make a bunch of bets, and hopefully the law of large numbers will kind of start to kick in to work in your favor. But let's say let's say your investing total equity size is 50K. And you invest in 10 deals, and each you put in like a 5,000 number, which I think you said is the minimum for you guys, right? So, like early stage, let's say early stage investing, the win rate is incredibly low. We're talking about like 10% to 20%. let's just say you have like 20% win rate, meaning like you actually make some money out of like 2 of the 10 investments that you put money in. And each of the, on average, each of the deals that actually you gain that has a positive return, it returns like 10x. That will be a rate of return of 20%. So basically you put 50K in and you return 60K. However, if you hit like one unicorn, which is like you said, it's the 80-20, actually not even 80-20, it's 9-10 probably.
Right.
For some of these like large venture capital firms, it's not like they are really doing well on average. It's because one or two of these things that really goes parabolic. So let's say even if you have like a 10% of win rate, but one of those deals returns like 100%, not 100%, but 100x. So basically 10,000%. That will give you a rate of return of 800%. So if you invest in 10 deals, nine of them fail and you get zero money back. But one of them, hit it at 100x. So basically this will be like 100 million valuation goes to 10 billion. It will give you 800% return from that one thing.
Right.
But that's
yeah, and what I'm hearing from you is that most of those went to zero. And so if somebody had bet all of their money on one of those individually, then they're not likely to be successful. But if they had put, a portion of their money into each of these, then it ultimately leads to a great outcome.
Yeah, so if that's why I said I agree with what you're saying, because there is a law of probability here. If you just invest in one of those things and you put your entire 50K in it or 100K in it, it's like, well, what's the probability of that working out? But once you have a portfolio, you can calculate it based on, okay, what's the historical win rate of this type of investment and what will be your expected return, that kind of thing. But that only works if you invest in a sufficient number of deals.
That's right. And, then you kind of get into the question of, okay, well, how much am I really willing to put into angel investing? And I would kind of go back to that comment earlier that once you put it in, it's there for a bit, and so you don't really know how long it's going to be illiquid, and so that really means that it truly depends on your specific financial situation whether you really want to put a bunch of money into the market or not. And for some people they have an extremely high conviction because of certain things that they've done or experienced within Web3 that makes them say, I want to put 80% of my net worth in. Whereas, I think Fred Wilson said something like 5% should go into, as a max, should go into a space like crypto. And so you can get some really wide pieces of advice in that kind of domain. And really, at the end of the day, you kind of know your own risk tolerance and, liquidity needs and judge those accordingly.
Yeah, seriously, because not everybody is, the same profile in terms your, how much capital you have, and how old you are, and what's your plan for your life, right? So a younger person, if you're like 19, 20 years old, if you lose it all, you probably have another 10 years to make it back.
Yeah, exactly.
So you can put higher.
Exactly. Well, and it's funny because people, depending on their disposition or risk tolerance, can also comprehend rationally that their expected returns are X, Y, Z, and that it might be a good decision to do one thing. But like my wife and I just got a car, and based off the interest rates and inflation, and my conviction that we're in a kind of longer term, higher inflation environment for the next decade, I thought this is great. This is, arbitrage. So, very limited amount down and locked in a giant amount of debt at a very cheap interest rate. And the only problem was my self-knowledge, the next week was, I really don't like having a bunch of debt. And so even though it's capital efficient to take that on, for someone like me, I said, okay, well, I just want to pay this down. I don't like having this debt. And so, depending on your own risk tolerance, even if you understand that the returns are one thing, everybody has their own idiosyncrasies and wants to take certain exposure or not. And so that certainly plays a role here in angel investing too.
Yeah, totally. So, but I'm curious to know, like, for you personally, what would be your thinking in terms of your personal portfolio? How much do you put in this type of early stage investing in terms of percentage allocation?
Yeah, it's a great question. So I would say for
keep in mind, you like Paul just had a baby. He's in like I know. Are you in early 20s? I don't know how old you are.
You're about to early 30s. You're about to beat me to my disclaimer, which is that Paul just finished paying off business school. So I would say by the end of 30s, what I want to have done is put gosh, I mean, again, in the back of my head, I'm thinking, well, what's my son's situation in life going to be at? The intuitive part of me says, I know that I'm not as good as many at hodling when the market gets volatile, but yet I have a very strong conviction for what's getting built out throughout crypto. And I think there are a lot of incredibly smart minds building in this space. So personally, I would love to have 80% of my net worth tied up in things that I can't touch, can't screw up, and just can leave to strong, high quality builders.
Now I see why you kept mentioning at the beginning. Oh, this is a way for you to tie things up if you can. Yeah, totally.
Philosophy is autobiography at the end of the day.
For people who are not who want to hodl but who cannot hodl, who know like you. If you like, things tomorrow drop 20%, you got super nervous, so you can't do it. Like I cannot. That's why I, mostly nowadays I do like more short term, trading, in the liquid token space. But if you want hodling, this is like forced hodling.
Exactly. And I say 8%. That's not all angel investments. I have like strong conviction in like the Ethereum ecosystem, for example, and I think there's kind of a evolving mix of how much you want exposure to like fungible tokens or to certain ecosystems that have already been built out that are if like many people that I interact with on a daily basis, if you're based in the US and you realize your home you own is denominated in dollars and and it's located in the US and your job is based in the US and all of your currency and cash reserve is denominated in USD, then you're kind of not diversified beyond your own nation risk. And so maybe there's some validity to owning some Bitcoin or Ethereum or some of these other layer ones that are doing interesting things as well. So that's kind of a broader discussion that gets me out of my scope of angel investing, but it's just kind of how I think about the market. I'd be remiss to say that I'm not also allocating a bunch to those areas. It's kind of 80% to crypto, the rest in cash or something else, right?
Yeah. So, and also I think it's also a decision based on what your competitive advantage is, because
that's a great point. Yeah.
Each of these investment style, it's a investment style, right? It's like this type of angel venture investing is like extremely low win rate, but if you hit something right, return can be really high for that single thing. But it's like it can be extremely volatile and the holding period is long, and you need like to make good judgment assessment on projects. So that's one particular kind of skill set that is very different from the skill set that you see like every day on YouTube, people talking about, okay, the support resistance levels and this line, that line, right? The triangles, the flags, that's like a very different skill set. But to do anything well, you have to specialize, right? But what you specialize in also depends on your personality and where your strength is. So to me, like personally, I know that my interest and my background is more in, in the liquid market. So, but I, long term optimistic in the space, and I'm obviously very involved and interested in the space. So for me, it's really sort of kind of a public good investment plus some diversification, but it's not a huge focus of mine. So personally, I allocate like 5% to this, angel investing. But that's just like, I just wanted to like give, because that's an example of course, my situation is different from everybody else, but that's just like an example of you have to look at what's your background and interest and where your expertise really lies.
Absolutely. Yep. And, one thing I would just point out in the bear market is that, as you're engaging in either angel investing or, one of the most fun parts about this whole experience with WAGMI for me has been that it's, there's more to wealth than what's quantified in the, liquid or illiquid assets that you're holding. I mean, just getting to meet so many interesting forward-looking people who are, I think, particularly in crypto, trying to rebuild a new version of the internet in a way that's exciting and more equitable or more autonomous for people, more self-sovereign. I think just puts you in communication with a bunch of other very genuinely interesting people. And so getting to build those relationships and build that network for you, if you're kind of actively looking at angel investing, that's kind of hard to measure the value of either, and that compounds. It's kind of a Metcalfe's law of its own as that network starts to grow over time too. And so there's just a lot of value to getting yourself out there and even just looking at these opportunities, whether or not you're putting capital into them.
Mm-hmm. Yeah. So, and also I want to ask you, like, in terms of this year, what's your plan or goal or things that you want to achieve for the syndicate?
Yeah. Oh my goodness. So we're constantly trying to catch our breath to, figure out new ways that we can engage with our current portfolio companies, because it's just so much fun trying to make those connections for the companies that we do have in our network. I think there's, of course, always the goal in terms of how much capital you'll have deployed and how many deals you'll do. I think sustainably, our goal would probably be to hit 50 portfolio companies by the end of this year. So that's kind of reliably tracking towards another deal every 2 weeks, a little bit under that. And then I think in terms of capital deployed, under promise and over deliver. It'd be nice to hit 10 million. We'll probably blow past that in Q2, but just at the rate that we're going. But yeah, I think the goal for us is to continue to build a network of really interesting people. And I think, again, coming from a TradFi background, I don't want to do anything that's kind of on the edge from a like regulatory or compliance standpoint. We're going to wait until hopefully Congress issues some clarity as to what security in crypto actually looks like, and hopefully there's some more rules around governance that kind of clearly get laid out before we would do anything in a more decentralized way. I mentioned earlier, once you issue a token, the cat's out of the bag at that point. So for us, I think it's just continuing to stick to the bread and butter of finding exciting deals that we can bring to our network, continuing to grow that network, and then living up to our promise of just trying to create value for the companies that we're bringing these networks to, as opposed to just money that we're leaving at the doorstep. So, yeah.
Well, thank you so much for joining me today. This has been a really fascinating discussion.
Yeah, thank you so much, Tascha. Great to come on.
Yeah, so for people to find you on the internet, like do you have like a Twitter or something that you want to leave with people?
Yeah, sure. I would say, you can find WAGMI Ventures at WAGMI_VC on Twitter, or our website if you want to sign up and get access to the deal flow. We're wagmiventures.io. And then I'm DJ_Paulie, it's PAULIE_P on Twitter. I have a pretty boring Twitter account, but you can follow our WAGMI Ventures publications via Twitter.
That's great. And if you, for those of you who want to check out the syndicate, I'll also post a link in the episode description so you can check it out. There is because I'm a partner of WAGMI Venture as well, but I have application process for people who want to join the syndicate, because we want to attract people who can actually contribute something to the space, not just money, but also your expertise and other things that you can bring, because that is, again, as we talked about multiple times, that's the collective value added of the syndicate, right?
Yep, we appreciate it, Tascha. Thank you.
Thanks a lot.